Today, we want to talk about China's power crisis. This is not only about an economic issue. In fact, several of them. China is having almost a perfect storm. It is not only about the political consequences. It is about electricity power. Today, as we speak, 20 out of 31 of China's jurisdictions are under electricity rationing. This is affecting a wide number of sectors, a lot of small and medium-sized enterprises. And of course, it has macroeconomic impacts. The difference between this and the regulatory crisis about fintech, about data storage, about all that sort of thing is, and healthcare and education, is that those sectors were identifiable. A power crisis affects everything. Now, let's go into some of the background. 70% of China's electricity output is made with coal. Most of that coal is produced domestically, and most of it is dirty coal. All coal is dirty, but some coal types are dirtier than others. China signed on to a zero emissions policy in 2050. But measures to get there were decreed and implemented from the top down immediately, so that there were climate goals to cut emissions, which had to be achieved this year. And these resulted in local authorities, regional authorities shutting down or limiting the use of dirty coal. Now, you may say, well, if this is costing you economically, why don't you just reverse it? We'll go into how to reverse it in a minute. But you have to remember that in a state organized on a Marxist-Leninist basis, like China is, decisions are taken at the top and then spread out like a fan to the base and to the real economy and financial economy. And they do not reverse, as market signals say this is causing a problem, because of the nature of the way that decisions are taken in this sort of an organization and the nature of the way they are applied, and they cannot be reversed simply by market signals. Secondly, the cost of coal in China has been rising since 2016. The difference today is it is rising exponentially because there simply is a shortage of coal, because mines which produce dirty coal have been closed down. The second factor is that electricity prices are very complicated, but they are administered prices in China, and they are frozen. So what has been happening is that the price of coal has been rising, and the price of electricity has not. The result is that there is probably not one single electricity utility in China which is actually making a profit, even a positive cash flow. So, not unnaturally, electricity companies have been cutting back, and the highly leveraged ones, which are in a dicey liquidity, if not solvency position, have been cutting back on more. So that's why there is not enough electricity in China. Now, demand for electricity has been growing very strongly. Partly this is because the economic recovery, whether for domestic use or exports, has really been based on the manufacturing sector, which is electricity intensive compared to the use of electricity by the tertiary economy or the service sector or households. That is one factor. The other factors we've discussed is supply. And the third factor is that the weather is uncommonly hot. Climate change is occurring in China as elsewhere, And the result of this is twofold. Number one is there's more demand for things like air conditioning. And number two is that the normal output of electricity from hydroelectric sources is running very low because the level of water in the dams is very low. So we're left with 70% of electricity being from coal, only 10 or 11% from renewables, and there isn't enough being produced from coal to satisfy demand. COVID is not, or has not, made things better, and particularly Delta, because it is still resulting in lockdowns in China and working from home. And in fact, many people have switched to running their little businesses, their small businesses, from home permanently. And some employees work permanently from home, or at least part-time. So in a climate where it is frankly very hot, and it still is very hot, even from where I speak, unnaturally so, the demand for aircon is huge. And huge compared to last year. For instance, our aircon bill here, where I work from home, and I'm talking to you from home, even though it looks like I'm talking to you from the galaxy, our aircon bill is running at approximately twice the level it was this time last year, both because prices have gone up and also because we're using a lot more of it. Now, this would be bad enough, but China is also in the grip of what I termed in the beginning a perfect storm. First, there is Evergrande and the real estate sector. Housing is 20% of the economy. It is most of mortgages. It is most of bank lending growth. And the result of Evergrande is, of course, it's not going to bring down the economy in the way that many doomsters are saying, but it is a major crisis. And it will only be made good by the state intervening to give people houses which they contracted and partly paid for, and to prevent contagion getting out of hand. But it will not result in a reversal of quite restrictive housing practices, which are part and parcel of ensuring that houses are for living in and not for speculation or investment. And it will not result in massive macroeconomic stimulus. That is one part of the perfect storm. The second part of the perfect storm is ports and supply chains. We measure the amount of ships backed up in ports on both sides of the Pacific, in China, in Singapore, in the United States. And also, of course, we look at what's happening in Europe. And the result is that port contagion is not getting better. In fact, in the United States, it's getting worse, which affects, of course, the transit times and the use of ships moving containers from China. We estimate now that the travel time from China to the United States or vice versa, which used to be 12 or 15 days, has at least doubled. And that means that supply side disruptions affect not only the availability of goods, but of course the price of those goods, where transport becomes a much more important factor and is either passed on as increased prices or comes off company profits. And of course, if it is passed on and increased prices, it means that inflation goes up. Now, the energy sector, of course, is a crisis which affects all of the sectors operating in China, not only manufacturing, but also services. Common prosperity is where we have to move from the purely economic to the political economic sphere. Common prosperity, as we've discussed before, is in many respects the thoroughly worthy, ethical and moral decision to move away from the period of economic development in which extreme creation of wealth and income disparities was deemed to be beneficial to the population because it caused dribble down effects, which made everybody richer, which was, of course, true, but it's over. China is now moving to a new ideology, which is a massive change, called common prosperity. Common prosperity is effectively the creation of a whole new swathe of middle-class people who will be much more moderate in their appetites and much more, of course, socially disciplined than the economic model that China has had. This is all well and good. It may work, it may not work. History will tell, and so will a rather lot of analysis beyond the scope of this. But there are transition costs in going from what is essentially a private sector, entrepreneurial, extreme wealth and income differential based model to a model which is, after all, based on the sort of equalities which are represented in Sweden, but this time without a vote. The costs are because it is a redistribution of income from the private corporate sector to the middle classes, which are to be created and will take a decade, but it passes through the state. So you are looking at something which is anti-investor and anti-profit in order to even achieve what it sets out to achieve, if it can achieve what it sets out to achieve. These four elements, power, real estate, which affects both credit creation, confidence, and housing, which, as I said, is a fifth of the economy, port and other supply chain disruptions, and common prosperity are the four planks of the perfect storm. Now, what will be the political response? I do not believe for 1 second that Xi Jinping, who is intelligent, ruthless, and ideological, is going to change direction and reverse the achievement of common prosperity. I think the PBOC will and is printing more money. But that is really to keep the system liquid and prevent systemic contagion. I do not think that the housing crisis will result in massive fiscal stimulus. The combined fiscal stimulus of all the different segments of the public sector in China is already running at around 14% of GDP. And I don't think they want to add to that. In fact, in many ways, I don't think they can add to that. So I don't expect massive fiscal stimulus. This means that China is on its way to the first recession on a quarterly basis, that's quarter on quarter, that I have ever seen since the great social disruptions in China, some of which I did live through. I think the third quarter, we'll see GDP growth at between -2% and -3% Q on Q. That is a massive occurrence. In the past, recessions in China were defined as around 5% to 6% growth. We're now going to see a real recession. That is key. Secondly, we're on the way to a much lower structural growth rate than the markets are expecting, than the great international and financial institutions are expecting, or of course, that your favorite investment bank or broker is expecting. Everybody says, well, it's going to be 8% growth in China this year, and it's going to be 6% next year, et cetera, et cetera. We have to come to terms with the reality that an economy at the stage of development, well into the middle classes of China, facing the structural problems that it does, and the cyclical and structural problems which I have described as the perfect storm, is going to grow at a growth rate of around 4%. Some commentators, the sort of people who have been predicting the death of China from leverage and whatever for years, now say, well, there will be no growth because the property sector, which is 20% of GDP, really is what drove growth. And that and everything else has really been driven by a leveraged bubble economy, which isn't going to be there. And it is true that those factors are going to weigh on growth in China. But it does not mean that there is no growth available to China. And the reason for that is you are still going to have 1.2 billion Chinese people who are going to go to work, the majority of them in sectors which will continue to pay them. And they will continue to spend their money as things become more available and cheaper, particularly in terms of housing, but also in terms of the achievement of some of the goals of common. I told you so. This is the collapse of China, because it is not. But there is no doubt it is a perfect storm. Thank you for watching. Talk again soon.